All right, everyone. If you'd like to come back to the program, take your seats. We'd like to resume in just a minute or so. So I see we have our venture capitalists here. I'll do a quick introduction in just a minute. But as everybody's coming back, we promised that we would deliver 5 copies of this book, Business Model Validation, to 5 of our attendees. If you want the book, you don't have to accept it. But this book, Business Model Validation, I wrote it. When you're looking at a new industry, sometimes it does help to look at some parameters as far as what constitutes a successful business model. So you're welcome to read that. The winner of this one is Jason Devitt from Compound I. So Jason Devitt from Compound I. If you'd like the book, we'd be happy to send it to you. All right, so we have our next speakers here. The next session is going to be what venture capitalists seek when investing in AI companies. So speaking on this topic, I'm very pleased to introduce 2 very successful venture capitalists. We have Stephen Bernardez, a partner at Pegasus Tech Ventures, and Keith Camhi, a managing director at Techstars. They'll do a fine job for us. So we'll make this an interview type session. I think, Keith, you're still on mute, so you might want to take yourself off of mute. So thank you, gentlemen, for joining us. Pleased to have you.
Good to be here.
Great.
Good. So why don't we start with Keith? Why don't you tell us about the verticals that you're most attracted to in AI? Maybe specific names of the verticals or the parameters, what constitutes an attractive vertical for you?
So for me personally, and then maybe Techstars broadly, and for those who don't know, Techstars runs accelerator programs around the world, and they might have different vertical focuses with any given accelerator. So as a managing director of one of those at a time, I might have a specific investment focus at that time. My upcoming program is on healthcare. We run with a healthcare program in partnership with Permanente Medicine in the Washington, D.C. area. And so all solutions that are impacting healthcare and value-based care delivery are in the sweet spot for my thesis. I will say a little more broadly, and having run a number of different programs with Techstars, that what I find most compelling as an investment thesis today in AI at our early stage, which is this pre-seed stage where we're unlikely to fund a big foundational model, for instance, is going to be the applied technologies in a specific vertical, as you say. And those tend to come from founders who have a unique insight into a problem space that is disruptable. And so, and there at these moments when new waves of platform become available, vertical after vertical is going to get disrupted in some way. I mean, we've seen it historically. I mean, even when Windows came out, and then web solutions, and then mobile solutions, and now AI, you have this just ripple effect through all different industries that can be disrupted. So ones that, for instance, and this is not exhaustive, but ones I've invested in and that I'm really excited about are sales enablement. I have a wonderful company called Fly.ai that's doing lead gen for early stage companies. It's a great one for any other startups. The field of PR is an interesting one. I have a company, Rally AI. It's a PR expert who's now doing what he used to do 10x faster, better, cheaper, literally less than a tenth of the price of getting him as your $10,000 a month PR agent. You can now get Alex in a box at Rally AI for $850 a month, and it's just as strong. So sales, PR, education is a major space. I've done a few companies in legal tech and legal enablement, and even mental health. Student mental health is a big one, not as a replacement for the therapist, but as the triage into whether you should be using resources or a human. So anyway, that's a broad scope of ones, but happy to drill into any of those in more detail. But it's a broad range of anything that could be done 10x faster, better, cheaper in a vertical by leveraging this platform.
Okay, great. Thank you. Stephen, which verticals do you like, and what do you look for in verticals that you invest in?
Thanks, David. And just as in terms of way of introduction, I'm with Pegasus Tech Ventures, which is kind of a corporate venture capital fund as a service. So we run 40 plus corporate venture capital funds on behalf of large, mostly outside of the US companies that are looking to get access to US based and Silicon Valley based innovation. And the needs of those large corporate LPs kind of drive where we look in terms of AI applications. But those companies do span a broad range of mostly traditional industries. So they're not, in general, high-tech companies. They're in healthcare, finance, energy, manufacturing. And so when we look for new innovation, which is mostly AI-driven these days, we look for kind of aspects of those industries that can be improved with AI. So verticals with deep or problems that can be solved with deep data sets, or with clear labor productivity gains that AI could drive, kind of how Keith was talking about Rally and PR. We're looking for those kinds of problem opportunities to be solved. And any industry with high customer service costs that can be automated, leveraging AI to provide not just productivity gains, but better customer experience. So it kind of spans a whole set of verticals. But again, healthcare, finance, energy, even manufacturing are areas that we focus on.
Okay. To what extent can there be moats that protect some of your portfolio companies? What forms might these moats manifest themselves in?
Keith, do you want to take that first? I'm happy to go if not.
Yeah, sure. I mean, I think the answer is yes, there can be moats in a lot of the ways that moats traditionally exist in any sort of startups IP is an example of it. Land grab opportunities and being first to market and moving quickly, but then doing it in a way where the users have a great experience, so they want to keep using it, but then their use of your platform makes it inherently more sticky to them, so that they're effectively switching costs because you don't want to move your history over to some other platform. So I'd say it's so far I'm seeing it as not unlike any other moat in another tech software field and those kind of traditional applications. But the buildup of data becomes more and more relevant in an AI solution. So that's a multiplier effect, especially in a vertical. So those cycles are very helpful as well. But I'd say I see it as similar to other categories.
Okay. Steve, would you like to talk about moats?
I would actually. But I'm on the same bus that Keith is here. We see, at least on the moats that are kind of unique or special for AI. There's data moats. So, the data flywheel, kind of the self-reinforcing cycle that Keith was talking about, where kind of initial data collection leads to improved models, which enhance user experience, which attracts more users, and then that generates even more data for you. And so if you can establish that kind of a self-reinforcing cycle, that's valuable as a moat. Just starting out with proprietary data. So having kind of unique and valuable data sets that are hard for competitors to replicate, such as commercial lock-in or data scale or regulated data access. All of those things can give you some sort of a lead and some sort of a moat. The product experience. So if you can enhance the product experience via an AI model, making it difficult for competitors to kind of copy that same experience, even if the data or the model is somewhat replicable, getting a brand around that experience can be a moat, certainly for some time. There can be algorithmic moats, but that feels less defensible over time. And so at least that's our firm's perspective. And then even in the short term, there are infrastructure moats. So do you have access to, in some differentiated way to compute and to GPUs? There are VC firms offering that to their portfolio companies. And it feels short term, but it certainly can be a moat to give their startup companies a leg up. The rest of these things are kind of, in terms of moats, are are general across all VC funded companies. Brand, speed, customer network effects, all kind of the other things that Keith was talking about.
Actually, you made me think of something. Maybe adding in one more, building on that. Another moat that I am seeing in AI, and I think again is typical in other space. In fact, I think Steve Case even talked about this in his book, The Third Wave of the Internet. When you start getting to industries that have either regulation or gatekeepers to access the customers, think fintech, healthcare. Your ability to go navigate those and get those partner relationship or regulatory approvals is it feels like a hassle at first, and it's like, oh, I don't want to do I want to fund a company that's going to have all this overhead before they can get approval or get these partnerships with a healthcare provider or something. But then once they get those, that's really hard to replace, and so that's and it should be remiss not to mention that as an example, in the program that I'm running now in healthcare, we're doing it in partnership. It's a Techstars program. We're doing it in partnership with a major healthcare provider in the Mid-Atlantic, Permanente Medicines Group here, the Kaiser Permanente physician group. And so the companies here, what we're betting on is having access to that kind of a provider and proving value to them and getting embedded potentially in their system will create a real upside opportunity for the company to expand more quickly, but then a bit of a moat for others who might be doing a similar solution and don't have that kind of access. So I think figuring out how you can navigate those gatekeepers and regulators can be, on the one hand, challenging, but then on the other hand, extremely, extremely powerful.
So if Mr. Sun from SoftBank were to approach one of your portfolio companies and he got excited and wanted to basically buy the business, not the company, but have the company buy its business, and just put a huge amount of money into that company, would you look at that as being a moat? A good press would come out of it. They could afford to hire these industry people to open up doors that Keith is talking about, at the healthcare companies and so on. Or would you look at that as saying, if you flood my company with cash, management's going to get sloppy and take their eye off the ball? How would you approach that? Yeah, Keith, you want to start? Or
yeah, Steve, why don't you take that one first? I'll think about that for a second. Yeah.
It's a great question, and I think it depends on what type of business the startup company is in. For example, if you're in a foundation model company like an OpenAI or their compatriots, of which Pegasus is actually an investor in a number of them, capital is a moat because they're trying to win, being the foundation go-to. And to do that, they have to build out the capital requirements to build out the hardware is breathtaking. You may have noticed, part of the last big deal of Q1, OpenAI's $40 billion raise. That was almost 60% of the money raised over that quarter. So it truly is astonishing how much money in what has been a rather down VC market for the last few years, these companies have been able to aggregate. And obviously we are seeing SoftBank coming into those deals. So that's one class. Now, if you were talking about a vertically applied AI company, that's a different discussion. And I think there can be more of a, it may not be winner take all or a heavy capital expense oriented approach. And in that case, I think judicious application of capital seems more warranted.
okay. Keith, did you want to comment on that too, or we can go to the next one?
No, I agree with all the above. I think too much. So as an example of the latter, too much capital at a stage when a company's not ready for. Capital is great when you can do more of something you already know how to do, and then you need to pour gas on the fire, whether that's the technology you need to build as a foundation model, or the go-to-market strategy that you have working. So by the time a company is Series A ready, they probably saw de-risk the product, found product market fit, and know how to deploy more capital, get more customers like the ones they already have, right? So that's kind of a typical Series A. Getting ahead of your skis on that is probably going to break your cap table, first of all, because the valuation won't be right. But then, secondly, can lead to odd irrational behavior that's not necessarily productive. And the last time, having run a company during the internet bubble that was not a bubble company, but seeing companies come in out of left field into our little niche market of fitness technology, build things that made no sense, and then burn through all the money and crash and burn. Too much money and something that's not ready for it is not necessarily a great thing either.
Okay. So next question, maybe we'll start with Steve for this one. To what extent do you want to see your portfolio companies receive patents? Is this something that impresses you, or is it not really worthwhile in terms of AI? Is it too easy to design around patents that are issued and you don't want to disclose too much as proprietary?
So from my particular perspective, is that patents can be useful, certainly as a way to ensure you have freedom to operate and you have currency to trade at some point in the future. But unless it's truly a fundamental patent, and I find that more valuable in areas like material science or even healthcare. But I find it less valuable in, say, software, which is where I tend to focus. Now, there's lots of exceptions to that rule, but I find patents more valuable the larger your asset base is. The ability to prosecute and enforce those patents. How valuable they can be for a very early startup company is maybe more debatable. And I'd rather see the ability to get your company up and running with more trade secret, or rather than putting all of your apples into the patent basket.
Okay. Keith, do you have comments on patents?
Yeah, I agree again on those points as well. And I will say also, from my own perspective, so I was a founder myself for a couple decades before switching over to venture capital and tech startups in the child education space and in the fitness tech space. And I did get patents in both companies, one on a sensor technology and one on a machine vision technology that was used in the product. I will say that they were not important, but they were a little bit valuable because they're a great marketing soundbite. so our patented technology, but it's not the main thing that would have kept competition out. Our main competitive advantage, for instance, from the fitness tech company was exactly what Steve was saying, which was our trade secret information. The patent that we had on the sensor technology that could sense fitness equipment basically was cool, and it was a niche, and it would be a little bit of a pain for someone to design around, but they could have found another solution for doing the same thing. The really hard part was all the software we built up around this solution that had so much nuance in it and so much knowledge of individual exercisers, patterns, and so forth that you wouldn't protect in a patent, but it would be a pain for anyone else to build. So I do think the trade secreting your secret sauce might be less likely to be in a patent, than in those sorts of things. Again, unless you're building something foundational in material science, like Steve was saying. So I agreed, and hopefully that gives a little color to it. But I do think they can be useful marketing because the end users and buyers go, patented technology is a easy line to say in a marketing statement. It's less than more succinct than a whole explanation of why you're unique.
Mm-hmm. Okay, so maybe staying with Keith, and this is a nice segue, the issue of marketing. It would seem that a prospect for one of your company's AI solutions, could be overwhelmed. There's a lot of money going into AI, a lot of competition. They're approached by many different companies. we all know that AI is new. We expect there's going to be some problems with it. It's not going to be 100% accurate right now. And it does take some time to learn the different tools. So, how important is marketing to you? What do you advise your companies to do to get the biggest bang for the buck on their marketing expenditures?
Yeah, a great question. So two different, maybe three different versions of that, depending on the type of company you're building. One is if you're, and I don't play in the foundation model space. We don't invest those kind of dollars. We're a pre-seed fund and so on. So that's a totally different answer. And if you're doing that, I'm not sure you're even on this call because you're busy. But the applied technologies, like the vertical technologies that we do invest in, there are two different categories of that I'm seeing emerge. One is things that are like obviously like known needs that are pretty broad, and a lot of people are already jumping in. Like it was, so as an example, sales enablement is a hotly contested category right now. There are a dozen companies doing it. I have what I think will be one of the real winners in that space for the long tail. So targeting small companies and startups for sales enablement. It's called Fly.ai, FLYE.ai, to put in a little plug. But that one, it's a slog. It's a typical head-to-head marketing. What are your different, most companies know they need that, know it's an opportunity because sales is really expensive right now and they're looking at AI tools for it. So they're already in the market, and you need to be better, faster, cheaper, show your differentiations, reach out using your own toolkit. And that's just straight on competition. Most of the other ones that I mentioned before, like the PR tool or the or education technology stuff, these are more greenfield opportunities where no one's thinking, people aren't out looking for an AI solution to their current PR approach. It's more like, oh wow, that's clever, and so that's more just getting the word out through guerrilla marketing techniques, word of mouth, and then the way to make it work and to prove it to customers is they got to try it. So if they start trying it, you do your first couple months of PR, and they already sudden landed an article in the New Yorker magazine or NerdWallet, which is the kinds of things that are happening with Rally. They're going to stick with it and go, oh, for $850 a month instead of $10,000, which I couldn't afford anyway, I'm getting real results from an expert. So slightly different go to markets, but then the proving it is, I think, through they got to try it to believe it.
Okay. Steve, do you want to share any of your insights for how AI companies should spend their marketing dollars?
I think they should spend their dollars getting proof points and use the output of that in their marketing. So I think BCG just did a study of 1,000 enterprises, and 4% of those respondents said that they were getting substantial value from their AI investments. And only 22% had gone beyond the proof of concept stage to generate any value at all. And so, I think enterprises are looking with kind of a jaundiced view, so prove it to me, as they should. And it is incumbent upon startup companies to show their value. And so, kind of in terms of cart before the horse, make sure that you have, kind of proof points that are referenceable, and you can go to market with in the first place. In terms of actually, hacking, going to market, the wonderful thing is there's a lot of new interesting AI tools, as Keith is pointing out, to make this more cost efficient and get more bang for your buck. And if anybody should be good at that, it should be AI startups.
Mm-hmm. Well, what is the revenue model of many of your companies? Is it to give the product away for free for a number of months and then start charging? If an AI product is being sold to larger entities, it seems like in some cases the manager, the buyer at that larger entity, almost feels compelled to experiment with different AI products. So if your company reports to you that, hey, Steve or Keith, we just got this engagement, or somebody's doing a big, evaluation of our product at Kaiser Permanente or whatever, Um, how do you know how to excited to get? You know, is it just a trial? Is it just poking around, or could it be a real customer? What, you know, how impressed would you be with something like that,
That
Steve?
for myself, I'm not impressed with free POCs because anybody can go, any customer can do that, and it doesn't indicate a large commitment. It tends to have an implication for what you can charge for it. So I really look for paid POCs if a company is going to do that, and particularly in the AI space. It isn't free to offer. It isn't like in the old days where you could just, ship some software and maybe have some customer service to handhold while they did the POC. Here you're actually running models that, even in the inference model, it costs money to run those things. And so there is a margin that you have to think about. So I'm less impressed with free POCs.
Yeah,
Keith?
same. And in terms of, so in terms of both what I look for when I invest and then what we advise companies on securing customers themselves, when we invest, I mean, revenue is your best proof point, traction going up and to the right. I mean, that is the, people are voting with their wallet, and that's the easy answer. If they don't if a company is applying to one of my programs and they don't have revenue yet, and we're trying to evaluate on something else, then I want them to have done the hard work on demonstrating that customers do want it, and there's a specific reason why they can't get revenue yet. Like if they should be able to do it and they're not yet, that's a negative proof point. If it's that, hey, we need FDA approval before we can get our first dollar of revenue, or I actually need to manufacture this thing before someone's going to pay for it, then what have you done to show that they're, that you're poised to turn that into revenue? So that's where you could, like a great hardware manufacturing company I have doing a wearable for people with disabilities, Lotus Ring, and they it took a couple of years before they could get revenue because they had to actually build this thing. It's a wearable, but they were getting what felt like real commitments to then purchase when it was ready, and so that's getting there. But if you should be able to get revenue now and you don't have it yet, it's the free POC is not gonna cut it. The other side of that coin, though, is going to market for these companies. Some of them should be able to get revenue right away, and that's like we have some companies using AI for transactional purposes that are immediate margin at the time of sale. We have a company doing expungements at scale. So for people with a legal record that needs to get cleared, Legalese helps do that, and that's just a transactional AI assisted to deliver on it, but it's margin right at the time of sale. Other companies do need to do free giveaways to make sure that the customers want it, but then it should be turning into revenue regularly, like Inkwire in the education space. Teachers want to play with this thing and see if it actually works in their classroom for creating project-based learning. But then when it does, they can roll that up into going after a district contract, for instance. So a lot of different models for go-to-market as distinct from how we would look to invest.
Okay. So maybe staying with Keith, maybe talk to us a little bit about the due diligence that you conduct. So, if a management team makes a presentation to you and you're pretty attracted to that idea, that company, what would you do as far as due diligence on an AI company?
Yeah, so we have a kind of structured process. We're unusual in our approach to selection compared to most VCs who are kind of in market to pick companies all year long, and they're supporting and because of the structure of an accelerator where we'll take 8, 10, 12 companies at a time into a class. I'm in sourcing mode for 2 months, and then I'm in selection mode for 2 months, and then I'm in run a program mode for 3 months, and then and so we're driving everyone through a similar process with a bunch of structured gates. So as example, right now, our application just opened yesterday for this new program. So for 2 months, I'm not going to be interviewing or diligencing. I'm going to be telling people about the program to get them to apply. Because of the volume that we process, we need a very structured process to go through selection and then diligence. And so we do an application process. You have to submit an application to get consideration. If that application makes it into our top 80 or so per class, you'll get a first interview. And that will look at the broad things: team, vision, market size, ability to execute, unique advantage. And then the top 40 of those might make it to a second interview, where we're really diving deeply into understanding the traction, examples of it, where you're headed. And then finally they get to some screening and some like real under the cover stuff, where if they have a technology, they're going to end up talking to a subject matter expert on that technology to really vet it in some detail, and kind of do that at scale by triaging where we'll get feedback from.
Okay, great. Steve, you want to tell us about any steps you take as far as due diligence?
Yeah, so in terms of Pegasus, we're somewhat agnostic in terms of stage, and it varies by stage. So if we're looking at a seed stage company, it's different from a pre-IPO company, obviously. Kind of at the early stages, we're looking at the team very closely. Do they have the right skill sets? Do they have a track record in the space? Do they understand customer need because of what they've done in the past? Do they have they shown they can run through walls if they're on the entrepreneurial side? Have they shown they can manage a startup if they're more on that side? We also look at the market opportunity, and we can validate that with our LPs, because we have a fair amount of LPs that are in, we're only investing in strategic companies to those LPs, so we can validate the customer need with them. In terms of the technology, same thing. We can leverage the smarts of the corporations that whose capital we are investing. In some cases, to do technical due diligence and to provide us a real world perspective on the solution that's being proposed. Again, we can check with customers on what is the need, what is their appetite for pricing, what's the business model that they would be, that works for them at the end of the day, given the way their companies are set up, and the appetite for different types of business models. So those are all kind of the same. It's standard venture capital, I guess, at the end of the day.
Mm-hmm. Do you have somebody evaluate the actual code to see if the code is written well, or do you just assume that it works?
That's a great question. We tend to rely on customer discussions for that. So we haven't done actual code review in general.
Okay. Keith, do you have somebody look at the actual coding?
No, I wouldn't typically look at underlying code. Maybe in a rare case where I'm like, I don't know if this sounds real. We might get an expert to look. But more typically, and again, at our pre-seed stage, I'm looking at quality of team and their likelihood of being able to pull this off, because it's not necessarily even their existing code base. It's what they're going to be building over the next couple of years. So I want to see that they've got the cred to build what they're talking about. So we might have a visionary founder who knows their space well, legal tech and expungements, right? But can they actually build what they're saying they're going to build? It's not necessarily, we're not in the rocket science stage of the technology there. We're in the application stage of it. So I want to make sure that the CTO is credible for executing on that particular solution.
Okay. And then when you're evaluating some of the principles of a early stage AI company, I think you make some reference checks and so on. But what can you really learn when the entrepreneurs are so young? And they're so young, they don't have that much history for you to get references on. So how do you determine if it's a good CEO that you're backing?
Yeah. You want to go, Steve, or you want me to?
It's a great question at the end of the day, actually, for very, very young entrepreneurs. We tend to look for companies for entrepreneurs that have a clear, deep background in the domain in which they're competing. And so, even if they're young, we're looking for an academic, PhD level or something of that ilk, level of understanding of the problem and the solution that they're proposing. And often we're looking to see how can we add value to put a team around them that can help them understand, and that can be the board, that can be advisors, that can be other investors. And so all of that kind of comes together around an opportunity to help support even a founder that may be highly technical, but may not be commercially experienced yet.
Yeah.
Okay.
And I mean, for what it's worth, most of my founders aren't that young, and that might be more of a virtue of playing in the application space than in just the foundation model space. But they come with some domain expertise about the problem set they're solving. So it's not that they're straight out of school with the latest and greatest tech, but they've got deep up. If you're gonna be disrupting legal tech, you probably know a fair amount about the legal industry, and that's going to take some time to have learned. And so they probably have, I think on average my founders have decade plus, maybe a couple decades of experience coming in. It may or may not be as a startup founder before, but certainly in their industry, and then maybe it's a serial entrepreneur as well. But with that, I mean, the three dimensions I tend to look at are on any founding team are kind of their call it general athleticism and ability to succeed with anything. So that's they have the raw intelligence, horsepower, and capability, resilience, execution pace. And then second is founder problem fit, even more than founder solution fit, because again, these applied techs, they need to have a unique insight into the market they're solving for. And then I do look at their ability to just articulate their vision. And again, we're talking early stage here, so this might not be fully baked yet. But if they can't like crisply and succinctly explain what they're doing, what changes it's going to make in the world, how the problem and solution makes sense, they're not going to bring others along in their journey. So I am looking for that communication skill that can tell the story, because at these early stages, the storytelling is such a key part of the fundraising. By the time they're Series A, Series B, the numbers start becoming as or more important than the story. But at these early stages, it's more story and painting the future. So they got to be pretty good at that. And that is testable in the interview process, because if they're not good at it for me, they're not going to be good at it in general.
Mm-hmm. Good. As far as deal structuring, is there anything that you do a little differently when you fund AI companies? Anything about the vesting of shares that's done differently, or meeting milestones to get a new tranche of investment, or meeting milestones to get a bump in valuation? And then one more part of this question is, do you sometimes require your companies to put their code in a holding company, in a special vehicle company, and take a secured interest in that? Anything along those lines? Steve, do you want to start this one?
Yeah, because I think Keith and I have different fund structures here. So that's a good question. And the answer for me is actually probably no. I mean, it's fairly similar to how for an AI company, how you would run a SaaS company. I would want to see alignment between investors and founders, meaning that the founders are motivated to stick around and build a valuable entity. And that's not done overnight, rarely done overnight. It takes time. If you look at how long it takes a company to exit, certainly an IPO, I don't even know what that outer number is. It was 11 years a while back, and I don't know what the current environment has done to that. It feels like the IPO window is completely shut. So you need founders to stick around. You need them to have a significant ownership stake, and you need them to vest over time. And so I would look for kind of the clock to start ticking when we get in at a kind of an early institutional round, a seed style round. I'd like to see a 4-year runway, and to put a vesting schedule in place that rewards and invests those early founders that are key to that company's success. In terms of any other kind of special structures, no, I'd rather not put quote unquote hair on a deal. So I would like it to be palatable for the next investor to come in and say, okay, it's a simple cap table. We haven't put anything funny around the IP, around anything else to make it harder for them to look at the next person after them. So my overall approach is to keep things clean.
Okay, Keith?
Yeah. So I guess first in terms of deal structure on our end, and then in terms of the how it relates to the founders, we're again unusual as an investor because in part due to our scale, we're running 20, 30, 40 accelerators a year around the world. with hundreds of companies that get in. And so we have a one-size-fits-all deal, which is transparent and known to everyone. And actually the breaking news as of yesterday, which you can see on the Techstars website, is that we've just materially increased our deal and the benefit of the terms to the founders. So we now invest $220K for what ends up being about 6 to 8%. A piece of it is in an uncapped MFN safe, and then a piece of it is basically 5% common stock for being part of the accelerator and Techstars and so forth. So that's a brand new deal that we just released, but that'll apply to everyone, whether an AI company, not AI company. So it's kind of up to the businesses to decide if they're at a stage where that deal makes sense for them, as opposed to us negotiating different deals for everyone. In terms of the founders sticking around, I mean, when they're at our stage, we would expect the founders to have the vast majority, if not 100% of the cap table coming in, so that they can withstand multiple rounds of dilution coming up from follow-on investors. Our capital is pretty friendly to the follow-on investors. Again, as a MFN safe is the it's common plus an MFN safe, so we're pretty friendly to anyone getting in. And like Steve said, we don't want to disrupt the future cap table. And for that same reason, if a founder's coming in already with a material amount of their equity spoken for at the time that they're a pre-seed, they're not going to make it through multiple rounds. So that would be the time to talk about whether or not they want to get this thing recapped right at the beginning and talk to those investors about maybe those early terms were a little onerous, but that's going to break their company. So that's one thing that we would tend to help them structure.
Okay. So maybe in the last couple of minutes, we can talk about any red flags. And the reason that we should talk about this, I think, is number one, it's some cautionary signs for investors, but it also allows the entrepreneurs listening to your comments, understand what they need to fix. So, Steve, you want to talk about any red flags that you've seen or that you would be cautious of or that you hear about in the industry?
If I was, there's a ton of red flags, right? So if you look at the kind of the yield rate for a VC in terms of the number of companies they talk to and see versus the ones they write checks to, I don't know, it's around 1%. And so did all of those 99 other companies have a red flag? It depends on your definition, but they may not have, they didn't, surpass the bar for that VC. In terms of the types of red flags that are AI specific, kind of for this, it could be data provenance. So the ability to continue to get the data that a company needs. Maybe they had for they swung a special deal to see, to do their original model, but may not have the ability to continue to get that data. That's something that could be an issue. Anything around the character of that data, in other words, is it a HIPAA data, HIPAA compliant, is it highly sensitive data that could be a problem for them going forward. If there's anything around the accuracy of their model for some reason that they don't seem to be solving, that's interesting and an interesting thread to pull. If there's anything around the capital efficiency of the company because they're not proficient in some way, that gives them margins that are not very attractive. If they're a little bit further down the line, I'm looking for traction growth because part of the reason AI companies are so highly valued, I mean, they're amazing. If you look at the late stage AI companies, a lot of them are, kind of the top 50 or so. I think Aventis has some data on this. They're valued at 30x revenue. The median SaaS company is 6x right now. So why are AI companies getting such a tremendously attractive valuation for themselves? It's either the market opportunity that investors are seeking, or it's actually revenue growth. Because some of these companies are astonishing how quickly they've been able to ramp their revenue. So then the question is for the others, why are they not ramping that rapidly? There's kind of a clear demarcation of those that are growing at such speed and those that are not. And it's a red flag if you don't seem to be getting product market fit or ramping that revenue.
Okay. Great, thank you. Keith?
Yeah, I mean, all of the above, and then I'd say at our relatively early stage, two, massive red flags that would be a quick no from us is one is don't lie about anything, so don't stretch the truth on your numbers, don't have something, whether in an interview or whatever else, don't do something that's demonstrably not accurate, and then. Second is lack of doing homework when approaching an investor. If they're not doing the homework on this kind of thing, which could mean as simple as having read our website and knowing exactly what we're looking for, or coming to your first interview. And if my investment associate can ask you about a competitor that you didn't know about, that's really bad. If we can, if on one Google search we came up with someone who you didn't track. So, those would be quick no's. But other than that, kind of what Steve was saying on things that we would get at more with diligence.
I would actually just say the biggest no is one that Keith just brought up, integrity. So, I'll run, not walk.
Yes.
The smell of an integrity issue.
Yeah.
Okay, great. Well, I'd like to thank both of you. I'd like to thank Stephen Bernardez from Pegasus Tech Ventures and Keith Camhi from Techstars for speaking to us today. I think it was a very informative session, and we know you gentlemen are very busy, so we really appreciate you spending some time with us and educating us a bit on valuing and investing in AI companies. So thank you, gentlemen. That will end this session. So let's take our break, and we will resume in about 15 minutes. Okay.
Thanks a lot.
Thanks, David.
Thank you very much. Appreciate it.
Thanks.
Goodbye.